Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 16th of May. I'm Daniel Lam, your host for the podcast. And S&P 500 hit an all-time high overnight, as it was risk-on from the inflation figure. Well, the April CPI print had been heavily watched because there were 3 consecutive months of stronger than anticipated CPI inflation. And consistent with the weaker than expected non-farm payroll earlier this month, the US headline CPI inflation decelerated to a softer than expected 0.3% month-on-month, which was 3.4% year-on-year in the month of April. And that's from 0.4% month-on-month and 3.5% year-on-year. Core CPI also eased as well. Now, declines in new and used vehicles prices largely explained the easing core price pressures in April, while shelter grew at a steady pace at 0.4% month-on-month. Now, changes in the new tenant rents lead existing tenant rents, and they have decelerated at a faster pace, while auto insurance prices are likely to stabilize in line with declines in vehicle prices. So the super core measure, i.e. the core services ex shelter, ticked lower from 0.4% month-on-month to 0.3% month-on-month. So indeed, income growth is a large driver of core services ex-shelter inflation. But of course, the real average hourly and weekly earnings eased in the month of April, and forward-looking indicators point to further deceleration. So risky assets reacted very positively to this data. Like we said, S&P 500 broke to an all-time high. And the kind of risky assets reaction that we saw last night was very similar to what we have seen earlier this month when the non-farm payroll grew less than expected. Like we said then, the CPI print helps to alleviate the emerging narrative about fears of a rate hike this year. So besides the S&P 500 hitting its all-time high, the US 10-year Treasury yield dropped sharply and is now testing the 4.3% support level. Likewise, the DXY index also fell sharply below the 104.55 support. So this reaction of asset prices may represent a continuation of a shift from the view that the US economy may be suffering from overheating to the US economy is slowing down at a measured manner. After a period of relatively shaky performance in US risky assets over the past 2 months, you may see the trend of rotation back into US assets again. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.